Well, as we sit here in this location looking out over DC, the hub of the government of this country, it's almost surreal to think back of how much has happened over now almost 2.5 centuries. And today, I'm just thinking we're at really some significant change that's happening right before us. Probably more so than in our lifetimes we've seen. Certainly in the realm of our history, we've seen a lot of ups and downs and disruptions, so we can go back and talk about that. But today, it's very, very significant in that the government really is at a reset right now. We've gone through a lot of eras of pushing the can down the road and letting things extend, and we've had markets that have been speculative and been pushed forward. But it seems like today that the time has come to really take things at hand, and the government's going hard. So we've got to change the dynamics here. What do you see as you look back with the generations, and you've had the opportunity, certainly through your life and through your parents' life, generationally looking at the landscape? What do you see for the country today, David? What are your thoughts about where we are and where we're going?
Well, it's a very critical juncture, and I think Stephen Bissett said it well a few days ago. We have been in a place that's unsustainable and moving towards what could be a major crash. And so if we don't do something, we're in trouble anyways. This is one of the most ambitious plans that any administration has ever put forward, trying to re-engineer the entire economy and strip out the waste from Washington. That's pretty ambitious. And to do that and to sort of bring back a manufacturing base and try to re-engineer the entire economy towards being more export driven, we've been so dependent on consumption and bringing in exported goods from the rest of the world. Now we want to provide goods to the world. I think long term, if he's successful, if the Trump administration is successful, it's radical and it's revolutionary and it's very positive. What we have to deal with is sort of the in-between phase where we're not sure what the pain is to get us there, and we're not sure the time frame of when these things are implemented and when the attempt is made, and how the market reacts to the in-between. So, the stock market obviously is very jittery. They're concerned about inflation. They're concerned about decline in the stock market. They're concerned about it, all the things that come with tariffs, and uncertainty is a critical point. You're starting to see it show up in major volatility in the markets.
There's been a long run of many decades of the passive investing, and that passive investing really started back in the early 80s and has really climbed over the years, and it's been relatively successful even during market cycles. But I think this is a time today, we've talked about it before, that really anybody who's in business or investing or really looking at generational legacy, which I think we all care about, is we've got to be more active involved with that. Financial advisors, people that certainly well respected and do the best they can, unless they've seen a full market cycle, which very few people have, and particularly in any particular given model. A lot of people are thinking, well, I'll just wait and kind of let this short-term period see its way through, and then I'll just get back to the ways it was in the past. And I'm not so sure that we're going to go back to what we saw in the past. It's going to be a new dawn, a new era. I think you're very right that the gap, the period in between, which I don't know if that's a number of months, quarters, several years, we don't know what it's going to be like. But figuring out how to hedge against that, to diversify our allocations, to keep enough liquidity, we call it dry powder, on hand. Everybody has to discern what that looks like for themselves. And I think learning about the cycles, being connected with people that you trust, that also have some proficiency in different arenas, is more important today than it was 5, 6, 10, 20 years ago.
Yeah, I think there's some similarities to the Reagan administration. When Reagan came in, there was initial pop higher in the stock market, and then we went into recession. And so the first 2 years were sort of plagued with negativity and downside, and things changed pretty dramatically thereafter. From 1982 forward, we began a significant bull run. Maybe one of the differences this time around is that we are at the end of a credit cycle. We've seen credit expand to limits that economies, not only in the US, but globally, can hardly bear. And some of that was response to the global financial crisis. Some of that was the interventions and the liquidity infusions from COVID. But we're now at a place where, as rates have come higher, we realize that, this is an issue. And so, the difference between now and the early 1980s, even if we were to head into recession now, we're carrying so much more debt as a percentage of GDP than we ever have. And depending on how you count it, it's anywhere from 100 to 120% debt to GDP here in the U.S. Economists have long thought that 90% was sort of a threshold for sort of instability, destabilization. We're well past that, even on the most conservative measure. And so it'll be interesting. I think what investors need to keep in mind is that the future won't be anything like the past. Your comment on passive investing, assuming that sort of the 60-40 portfolio mix of stocks and bonds is going to get you over the finish line, not going to happen this go around. When rates begin to move higher, when rates change direction, they tend to do that for decades, not quarters. And so the hope is that, we'll get back to usual, back to normal, back to growth, because rates are going to go lower. It's just that's not how history has certainly suggested the script will play out.
We get so used to what we've seen in the recent past being our moniker for what we'll see in the future again. As you said, maybe a short blip on the radar. Somebody's going to fix the problems and we'll get back to the normalcy that we saw in the past. But I agree. I think it's not going to be there. There's been such a reliance, as there has been for decades, on the financial markets, Wall Street, as you said, stocks, bonds, the 60-40 portfolio. There's been a lot more interest in, even the last decade, in terms of the alternative investments, the tangible, the hard assets. I've always been a fan, nothing against the stock market, but I like something I can kind of put my hands on. I can kick it, I can see it, I feel like I understand it better. And I'm even, in my own realm, seeing a broader desire to diversify more broadly into more precious metals, real wealth, gold, silver. We've been watching that in the last couple of weeks. As the rest of the market has been very jittery, we've seen gold continue to rise as we would kind of expect it to, although it can have a pullback. We can look at other aspects like commodities, certainly. Energy would be another area to look at. So lots of areas to look at, but it requires some diligence, some discernment, some understanding by the prudent investor to understand how those markets work and how they work in different cycles and how to allocate one's portfolio amongst those different assets.
Yeah, under normal circumstances, going back to gold and silver, I would expect them to pull back. The challenge here is that they're moving on the basis of radical uncertainty, and the central bank community has basically said, we don't know what the world's going to look like a few years from now. We don't know what, from the standpoint of international relations or trade relations, we're not exactly sure what the future holds, and they're hedging their bets, which is interesting. They've been the primary drivers of price. We have yet to see the investor community step in. So you're talking about a massive amount of capital that, for all intents and purposes, is under-allocated to those assets. And this week is a good case in point. You had some hopeful thoughts earlier in the week, and then by the end of the week, the stock market's not doing great. You start to see a migration towards gold, goes to all-time highs, and a move towards treasuries. So the move to gold is not so much a speculative, like, hey, let's go do something to make money. Moving in line with treasuries, it suggests that people are looking for safe havens. They're looking for taking some money out and putting it on the sidelines. Yes. So I think one of the best things that investors can do is de-risk a portfolio, increase cash allocations, hedge some of that with precious metals, and if it sounds like a sort of, is the world then coming to an end? Not at all. Things run in cycles, and sometimes it pays to have your options open. And I think for someone who is looking for growth, looking for income, one of the smartest things you can do is sort of take a step back in order to take 2 steps forward. And to me, cash and metals are the means of getting ready. Very few people will be in the same position to be able to take advantage of discounts in assets. And you're leaving all of your options open. That's what I would do is if you wanted to see things through a positive lens, you're in a position to buy when other people can't. That's typically when you get the best deals.
It's hard to do that, human nature being what it is, because there's the FOMO. I want to jump on, I want to catch maybe what I think it's the last train out because the market's there. So being patient as an investor, it takes a discipline. It is a discipline that has to be acquired. I think you need some accountability, but pulling back, de-risking, going to higher ground, and waiting for the cycle to turn. If you've been through some cycles, you've seen that before. But again, we look back at what's happened recently and go, I don't know if I can wait this time. I need to jump in. I think also we spoke this morning about the younger generation. Well, what have they seen through the eyes of their parents? Maybe they've jumped on to some of the retail investing that's been a big craze the last few years, and they've been excited about it too. How do we have the conversation with our younger generation to say that also is not quite normal? Maybe what you've experienced is some adrenaline highs, some euphoria that everybody's played with, but really we've got to get back to some fundamentals. How do we talk to the younger generation, and not to reduce their expectations, but to show them there is a prudent way to navigate disruption and uncertainty like we have today?
Yeah, I mean, I think some of the conversations need to go back to basics. If you think about the re-engineering of our economy, you're talking about a different kind of architecture where I don't think we have to be anything more than clear on the power of the arch, the flying buttress, the things that have worked for a long, long time. Diversification is a fundamental. If you're inadequately diversified, that's a fundamental you can come back to. It makes for solid architecture. If you're looking at the role that gold has played through the centuries, even the millennia, again, it's something that's been neglected, and I think there's an opportunity there. Broad diversification, super important. Appreciating that cash has an amazing value within a portfolio. Most people think that that's an uninvested portion of a portfolio. Sometimes people will ask us when we start to increase our cash allocations in our managed accounts, are we going to pay you fees on the cash portion because it's not doing anything? Actually, it's not only lowering the volatility of the portfolio, it's there to fill out the positions and optimize performance over time. And so again, I think that idea of taking a step back so you can take 2 or 3 steps forward, it's a very strategic, super important, and actually one of the most aggressive things that you can be doing, de-risking so that you can take appropriate risk later on.
With the discipline of investing over time, even small amounts, but not taking the big risks, not trying to hit the home runs, but just a compound rate of return that the market can deliver today, whatever that might be, whether it's in treasuries or in precious metals or whatever you feel like is your de-risk portfolio. But that compound effect is something that I know our younger generation can do well. You spoke about your father who started buying gold, how many years ago, 50 years ago, and just bought some wherever the price was. And whenever we invest in something, we always think, well, it's a high price today. Isn't it a high price? Well, based on the fiat currency, everything has gone up. So it's not a matter of, is it too high priced? Are you buying something that's fundamentally carried its weight over time that's going to be there for you? And just being disciplined about that fact is something that anybody can do, but just give enough time to do it. Don't wait too late in the game to try to make up for amends for what you didn't do in the past.
Yeah. You and I had a conversation a week or so ago about the Dow Gold ratio that came up. And it's helpful because when you look at prices of assets, and you can do ratios with just about any asset, so you get a relative valuation between the two. You might say all-time highs for gold, I don't think I want to touch it. Keep in mind that today it trades at 13.7 compared to the Dow, and at a market low in stocks and a real market high in gold on a relative basis, you can see it trade at 3-to-1, 2-to-1, 1-to-1. So you're talking about a pickup in buying power within an equity portfolio of, 4 times, 6 times, as much as 13 times. Yeah, there's that I think is a better guide to knowing what to do and when to do it and the degree to do it. So if I'm having a conversation with the younger generation, it's bringing in timeless things like that, where you can say, where should you have been in 1927, 28, 29, and what opportunities did you have in 1932, 33, 34? Where should you have been in 1966, 67, 68? What options opened to you in the early 70s? Where should you have been in 1979, 80, 81? I mean, these are long-term trends, and the ratios show you far more than price how to, again, if you're managing money on an intergenerational basis, where to put an emphasis. Today, stocks are still expensive. Now, again, relative to gold, actually, they've been even more expensive. What people don't understand is that relative to gold, stocks have been in a bear market since the year 2000. We hit a peak in that ratio of 43-to-1.
So what you're saying is all the run-ups on a relative basis aren't really there.
In real money terms, in nominal values, they're higher. In real money terms, you haven't made any progress. In fact, you've regressed in the last 2.5 decades I think we will see entry points. 6-to-1 ratio is what we had at the bottom of the global financial crisis. I think we could see lower than 6-to-1 in the Dow Gold ratio on this particular round, mainly because there's concerns about what the implications are for fiscal intervention. I mean, we're at a point where everyone knows you start adding a few trillion here and there, we're already at a break point. In terms of monetary policy, we didn't have the concerns of inflation coming through the global financial crisis that we do today. So the possibility of there being caution or hesitation on the part of the Treasury or the Fed to intervene in a market decline is significant. You mentioned passive investing. That's another thing that's been not just for individual investors, but institutions have had to conform to this because basically you can't beat the index, haven't been able to in recent years, and so everybody has become indexed. And if you want outperformance, then you just add leverage to that. But because institutions and money managers have been forced into the indexing game and basically a passive game, you have less people there as the quote unquote value investors to buy an absolute low. So what is the absolute low when your traditional buyers had to commit or get fired? They couldn't compete with the indexes, so they just all loaded up on index-oriented portfolios. So it's interesting. We do have Buffett. He's off to the sidelines with, was it $340 billion now? I think I would take a lead from that. Don't be afraid of having cash. Have some patience. A 9% correction in the stock market is not much. When you look at things through a technical lens, moving averages are kind of a way of smoothing out or figuring out what a trend is. Stock market, thinking of the NASDAQ, thinking of the S&P 500, thinking of the Dow, they've all traded below their 200-day moving averages. They've rallied back up and they've touched their 200-day moving averages and they're failing to retake that level. From a technical perspective, that opens up the possibility for significant declines very quickly. So, would I run from the room with your hair on fire? Well, it's not going to work. It's Friday. You can't put on any trades. You can't trim the portfolio today.
Too late.
But I think it's worth, again, looking at de-risking, increasing a cash percentage. And it comes back to this, things are changing here. Things are changing in DC, and they have ripple effects globally.
Right.
And we don't know what the implications are. Long term, I am hopeful. I want to give the administration the benefit of the doubt. I think that between Moran and Besant and many other advisors, there's a concept of reform which is positive. As Shakespeare said, there's many a slip between the cup and the lip. We don't exactly know what's going to happen in the in-between, and I think that's where the financial markets and your average investor are most at risk. Long term, this could be absolutely revolutionary, a renaissance for growth in America. But that could take a couple of years to get to.
Well, like you, I'm very bullish on this country. We've survived, several hundred years of history. I don't see this going away. We've got the Capitol, we've got the Washington Monument back here. I say we come back maybe 2 years from now. Maybe we come back to the same setting. We'll have the conversation again and see what's happened in 2 years. That's not a very long period of time. And as you said, there's a lot to get through with the current administration, what their proposals are, I think what their mandates are. I'm a fan of going hard at this point, but yes, getting through the period of time that we've got to get through for the individual person on the street, the investor, could be a tough time if you're not positioned well. And I think this is a time, if you haven't done so, to plug in and really get your game face on to understand what's happening in dynamics, protect yourself, position well, be defensive, be ready to be offensive at the right time.
Maybe the most important decision that an individual can make is to take ownership of decision making, and that takes a commitment to getting educated or continuing the education process, deepening it, and having one of the primary investments be in their knowledge of the financial markets. If you've delegated everything to professionals, understand that the professionals are operating, they're playing the game, but they're playing with the old set of rules. And sometimes you get to a new era, a new environment where the rules have been changed, but everyone's still playing by the old set. And so, taking some ownership of the decision making means that you have to educate yourself. You have to educate yourself.
And that's been something that for eons we've been told it's too complicated. Just let the pros take care of it for you. It'll be there when you need it, and not so anymore. I think it's very much a fact that we've got to take it into our own hands and utilize advice from people, but we've got to be the orchestrators of our own financial future, number one.
Totally agree.